Welcome to TheoTrade, November 4th, 2020. This is Don Kaufman doing the TheoTrade evening video. Spoos finish up a staggering 80 handles. I'm going to tell you what, though. You just objectively look at this and you start to recognize you've got a not-so-certain market future. Let's actually dig into a little bit of the trade that happened, of course, post-election. And there's a question mark over there, of course, because not exactly sure where the election stands at this point in time, nor is really anybody at this point. And again, some of the uncertainty is really playing out and really wreaking havoc with a lot of what we kind of term risk-on, risk-off assets. Let's get to work in this evening's video and kind of explore just that. I mean, one of the first things is, it doesn't look like that much in the chart, but the S&Ps are up some 2.3%. Take a look at the Nasdaq. It is a smoking move to the tune of almost 5%. Yet at the exact same time, the Russell, massively unchanged on the trading session. And everywhere I look, the marketplace has just these wild contradictions, bifurcations everywhere in this marketplace. As I said, we're going to detail just that. And this is not necessarily to, say, all right, we're going to probably sell back off. It's just to display, if you will, the incredible uncertainty that's still packed in this marketplace. And ultimately, I think a lot of traders are probably sitting there. You're like, whew, got through that one. It's all gravy from here. And I urge you to reconsider that thought process based on these factors. So one of the first things I'll point out, the S&Ps, still up, almost 2.4%. Take a look with me at the advanced decline line. All right, how many times in history have you actually seen an advanced decline line? This is specific to the S&P 100, almost a pure 50-50 with the S&Ps up, over 2%. I can tell you right now, I can count that on one hand, the number of times I've seen that over my 22-year career. So this is a little bit of a warning shot being fired across the bow that for the most part, the advanced decline line, you could almost discount it completely because today's marketplace was driven, by the monsters of tech, brought to you exclusively by the monsters of tech. The monsters of tech is this conglomerate symbol that we built here at TheoTrade, and that's all it is it's Apple and Amazon and Facebook and Google and Microsoft and ratioed together, but we created our own index. And are you aware that that index is up by the tune of 6% today? And those are the heavyweights. Those are the market caps, that matter. And what you had, occur in today's trading session, it's all about the big market cap, and everything else just, fell by the wayside over here. And that unto itself drove the S&Ps up and up substantially. But when you start to look at this as constructively as you possibly can, and, even to be, optimistic, it's tough to be optimistic when you have, 4 or 5 stocks literally holding the entire marketplace together. And it's been a while, but we've mentioned that before here on TheoTrade that, a handful of stocks. Does that make you feel warm and fuzzy that you have, almost a $2 trillion market cap? And if that $2 trillion market cap sees some sell side activity, there's no more diversification in the marketplace at this point. There just isn't, because if there's sell side activity here in Apple and there's sell side activity here in Facebook, it's over. There's nowhere to duck and nowhere to cover and nowhere to run to. And I'm going to show you just that. So the S&Ps ripped to the upside. But before I go any further with the S&Ps ripping to the upside, I also want to counter and say, well, the S&Ps did precisely what they were supposed to. And by that, let's go to the SPX. The SPX Expected Move. For those of you that understand this a little bit, I talk incessantly about expected move, and it's anticipation. It's the option market anticipating risk. And in this particular case, when I talk about the option market, obviously it's the election week. We're looking for this $160 move up or $160 move down. Were you aware that we tagged it? We came outside of it, and then we pulled back effectively right to the edge of the expected move today. So we're home. Say what you will about this marketplace, but the marketplace did precisely what we anticipated. And by the way, even here in the after hours, we've cruised down a little bit. Expect that we're probably going to open someplace tomorrow, maybe inside the 3428 level. When I say at or inside, I mean literally on this level in the S&Ps or even inside for the expected move. But the force is strong with this one, folks. $160 move is what we were looking for. I also want to kind of counter this, this move, and everybody's like, "Oh, it was a blistering move to the upside." But not only are we the expected move for the week, but check this out. If I cruise over here to the Analyze tab and I go to Think Back is just end of day data. All right, and I wasn't planning on doing this, but I'm going to show you something that again I find interesting. Is that were you aware? And this is based on yesterday. Here is November 3rd. Take a look at the November 4th expiration. You realize that we are actually expecting today, right? November 4th, we're expecting a $93, almost $94 move. We're inside of that. So the volatility actually was inside of it. So what had happened today was priced into the marketplace, completely, priced into the marketplace. So of course you're gonna counter with the QQQ, with the Nasdaq. It was extraordinary inside of the Nasdaq, really. Tell me how extraordinary was it? Because the Nasdaq for the entire remainder of the week, was looking for about almost an $11 expected move. So we moved a little bit beyond that. But again, to back up a little bit here on the week, the Nasdaq was expecting almost over a $14 move, and today it's effectively inside. A little bit of that on the week. Net, we're actually outside of it. But again, the expected moves that we saw today were not too wicked. Now I'm going to show you when I say this is a not so certain market future. So what brings me to that conclusion? I mean, first I wanted to hammer out the fact that nothing unusual happened today. Everything in the move was expected. And that's why I look at the expected move. This is where, put your game face on and recognize, listen, we were looking for a big boy move. We got a big boy move, and that's all there is to it. Okay. Now, onward and upward. Between now and Friday, we're still expecting about $76 of movement. So keep your helmet on. Don't go anywhere. Here's the bothersome portions of what we saw inside of the marketplace. It's the bonds. Let's actually start with the bonds. The bonds ripped to the upside. So as the bonds ripped to the upside over here, there's a lot of market pundits that came out and said the bonds rallied because the reflation trade is dead. Really? I mean, the bonds are really going to move that far in the whole reflation trade thing. Basically, what that means is like interest rates, which is TNX went down and went down considerably. In fact, it's worthwhile bringing that up from time to time that the interest rates did subside considerably today, which is one of the reasons, because the interest rates went down, that's one of the reasons that actually hurt some of the financials a little bit today. Not too much, but the financials, the financial sector was actually down by the tune of over 1%. Look down at some of the usual suspects. Bank of America off by 4%. Again, you have to recognize the S&Ps are up, 2.4%. Bank of America, JP Morgan. I mean, JP Morgan is in there in one of the top dogs in terms of market capitalization in the S&P 500. Citigroup, all of them are down. Check. Okay, and that has a lot to do with the fact that, again, the bonds rallied, taking the interest rates down. But here's the thing. I don't buy the story that the bonds just rallied based on the reflation trade. I actually think that part of this is what I call duck and cover. I think the bonds are being purchased because there's still considerable risk out there. But you can't just look at the bonds. Speaking of which, look at the bond volume out there. Put on your big boy pants. There was some volume of trading inside of the bonds today. So the bonds and the reflation trade, again, sure, some of the reflation trade, I buy into it, but net, I think a lot of this has to do with duck and cover. And that is, all right, people are looking for a little bit of a hedge. It's the only thing that makes sense. But as I said, you can't necessarily just trust the bonds out there. Now, we cruise over to the dollar. Interestingly enough, the dollar, well, if this is, if all the risk is out of the marketplace, the dollar should have sold off. Demonstrably sold off. What did the dollar do? For the most part, negligible. And it's the same thing as the Russell. It's almost massively unchanged in the dollar. So the dollar does absolutely nothing in the face of all of this. Then we start to, again, break down sectors. As I said, from a sector standpoint, the financials got hit a little bit, right? But then take a look at the energy sector. It finished unchanged. Now here, people, when I talk about a not so certain future, here, huge question mark. Why? If you're a believer there and you're sitting at home and you're trying to convince yourself Biden's got it, Trump's got it, I'll tell you right now, nobody knows nothing. Because if they knew one side or the other, the energy sector would have made a more substantial move, and yet the energy sector did absolutely nothing. So, of course, you're going to look at, oil. Oil's had a couple of up days regardless, but again, it's the energy services companies that are going to have that broader move in there. I'm also going to give you one that's going to confuse everybody here about, terms of like market certainty over here. Take a look at the FXI. China, okay? Who has won the election? Well, if it was Trump, I wouldn't exactly expect the Chinese ETF to be exploding to the upside. Is this pricing for Biden? Again, there's more questions in this marketplace than answers. But the one key component over here, right, is then you start looking at stuff like Caterpillar. It got absolutely crushed. Huge volume inside of today's trade. Everywhere you look, okay, there's conflicts. And those conflicts all point to one reality, and that is there's still a huge amount of uncertainty in this marketplace. And of course, somebody's going to counter with, well, look at the VIX. The VIX actually came down. Yeah, that's a 30-day volatility, but I'm going to show you something. I'm going to leave you with this thought, okay? Look at the Volatility Futures. The Volatility Futures. We did a wild shift in the Volatility Futures. This right here is the 14-day Volatility Futures. They're trading at 28.55, 28.55. Okay. Just yesterday, this Volatility Future was considerably higher. It was considerably higher, of course, than the December Volatility Futures, which we start talking about contango and backwardation. Basically, what we had in Volatility Futures as of yesterday was a wild inversion. And the wild inversion was, okay, this over here is 14-day vol, and it was up, like 33, and that came, and then we actually jump out here to the what? To like the 42-day. So that's 42-day, and that one was actually trading closer to, like 30. And this is what we start to talk about. Volatility was inverted, right? The 14-day vol was above and beyond the 42-day vol. And then it kind of continued out from there, and the volatility went lower and lower and lower. So what you're missing about volatility is actually playing a little bit of the shell game on you right now. What's occurred in the volatility markets, again, is pretty pivotal. And I think, 99.9% of traders are probably going to miss this kind of move because people don't typically read vol skew on a day-to-day basis. What happened was the risk shifted from, as I was saying, right up here was the risk in that 14-day, right? And then it actually dropped off here to the 42-day. What happened now is the 14-day dropped, okay? So this is now the 14-day. Then we jump back up for the 42-day, and then we start to, work our way back down. For the most part, what just occurred inside of the volatility skew is the volatility skew yesterday looked like this. Now, it actually looks like this, where, again, short-term volatility says, yeah, there's still some risk in the next 14 days. But now the bigger risk just got pushed out to December. How about that? Shell game, people. You better be careful at this point in time because the premise is simply that the uncertainty isn't just about tomorrow. The uncertainty isn't about the remainder of this week, that the uncertainty is actually going to be here for quite some time in this marketplace, which again brings me back to some key levels in the marketplace. You may have seen an absolutely pivotal rip and rally, but I still look at this and I still look at that 32.11 and recognize there's some unfinished business in there. And that's more than a hop, skip, and a jump away, given the fact we're trading 34, 40, 41. But again, volatility is far from over in this marketplace. You need to take the assumption that you're going to see more of it. And even though if you've removed some hedges and you're like, woo, ducked a big one on that, I ducked out of it and we rallied up and everything's going to be okay and you're high-fiving one another, better cool out for the time being. Volatility skews don't shift for nothing out there. And the volatility net is still elevated in the overall markets. Look at all the conflicts yourself, Make a decision for yourself. Again, I believe not only the days, weeks, but months to come are still going to be packed filled with volatility. Have a good evening, everybody. Bye-bye.